Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to Fundamentals, where I'm going to look at one of the most popular funds on the AJ Bell Invest Centre platform right now, namely Invesco Perpetual High Income. The £11.3 billion collective's mandate is to provide income, and it seeks to do so by investing primarily in firms listed in the UK, although at the moment 9% of the assets are in the US and 5% in Europe, as we can see here. Now, some may question the high income tag when the yield on the fund is currently 3.2%, which, by the way, comes in semi-annual payments, although note that with this accumulation class of fund, the cash will be reinvested. There is an income class available too. Now, this yield reflects the views of manager Mark Barnett, who's as well known as he is well respected. I've recently heard him speak at both an Invesco Perpetual event in London and also at our very own Investival, and his thoughts are pretty clear. He's not convinced that dividends can keep growing faster than earnings, as they've done in the past few years, and he does expect a slowdown so cover can be rebuilt. He's not convinced either by the reflation trade, which has become popular following the election of President Trump. Barnett suggests that key deflationary trends like debt and demographics have not gone away, and that price pressure is unlikely to desist either, even if the headline inflation numbers pick up. So firms with pricing power are the ones he's still seeking. He does flag how the UK has also become very split as an equity market, with dollar and overseas earnings in vogue and domestically focused stocks out in the cold. He thinks this is throwing up valuation opportunities among the domestic names, where he's just starting to dip his toe into the water once more. So, as a result of all of that, tobacco stocks still remain a key part of Barnett's portfolio. Reynolds American, British American Tobacco and Imperial Brands are all in the top 6 holdings. And interestingly, he thinks BAT may have to pay a little bit more if it's to acquire its US target Reynolds. He remains wary of banks' long-term earnings power, even if he concedes valuations look lowly, and prefers insurers for yield, while Barnett also feels the big oil firms' dividends are safe. And here he has a preference for BP over Shell. BP's the third biggest position, behind just Reynolds and BAT. All of this means that consumer staples and healthcare are still the biggest sector weightings within Invesco Perpetual High Income, while basic materials, the miners, well, they don't really get much of a look in. As a couple of final points, the fund is eligible for SIPs and ISAs, and it comes with an annual ongoing charge figure of 0.87%. So those are the mechanics. The question now is, why would advisors and clients potentially be buying now? Well, the worldview outlined by Mark Barnett himself, as briefly outlined above, will explain some of the continued interest in this high-profile fund. First, there's no guarantee that Trumpflation will prevail, so the dash from defensive to cyclicals and yield generators to turnaround plays, well, there's no guarantee that's going to continue either. Second, there's no guarantee that interest rates will shoot higher even if inflation does pick up, and that will still place a premium on dependable income. In addition, government bond yields are still below where they were 12 months ago, as benchmarked by the UK 10-year gilt, and a 1.44% yield here may not do the job for everyone. Third, earnings cover for dividends in the UK equity market remains skinny. Although we've had fewer cuts this year, and only Sainsbury's and EasyJet within the FTSE 100 have pared back their shareholder payments of late, a skilled and experienced fund manager should be able to add value for income-seeking advisors and clients by picking out dependable payers and dodging the dividend cutters. There are, of course, risks. Patience will be required given Barnett's style, and income could, for that matter, fall temporarily out of fashion if the reflation trade truly takes hold, leaving consumer staples and quality defensives out in the cold. In addition, every fund and every fund manager can have their blips, and Invesco Perpetual High Income has lagged its peers in the UK equity income category over the past 12 months. So, as with any collective, advisors and clients must ensure they think the collective represents value for money and that it also fits with their overall strategy, target returns, time horizon and tolerance for risk. Thank you for watching, and I look forward to seeing you next time.